What's good, everyone? Welcome back to yet another episode. In today's video, I'm going to be showing you why your strategy does not work. Okay, so starting first, what is your strategy? There's only so much ways of trading, and I'm going to list them right below. The first one, let's just say SMC, okay? SMC is known as Smart Money Concepts. I'm going to break each of them down once I write them. We have Malaysian SNR. Which means support and resistance. I'll just leave Malaysian SNR as the support and resistance branch. We have trend lines. What else do we have? I guess supply demand. These are known as like little zones. We have the infamous ICT. And then we have indicator trading. So starting off talking about indicators, right? I myself actually started off on this indicator strategy called 4 siblings, where I actually used 4 different indicators to tell me where price action was going to go in a prolonged period of time. And honestly, that worked for me. That worked, and I had some pretty good results. Like I turned like a 3K account into like 7,000 something. However, most of the time, like the reason why I trade ICT now is because indicators are delayed. Like now that I could read price action, by the time the indicator actually shows you where price is going, and it also needs some confirmation. So when price action is one-sidedly bullish like this, the indicator is going to be constantly on this like up, like over the other like thresholds to where it's time for selling. Like there is an overwhelming amount of buying pressure, and it's over like the mountain. So once it starts to leave some range, like once there's a little bit of sell side, the indicator starts showing you that it's going to start reversing. It starts turning around, and this is a very delayed way of looking at price action, because by the time it actually goes down on the indicator, you already missed the potential bearish move that you could have traded, right? So I'm not saying that indicators don't work. It's just that it's more like a trend following thing. And if you're really going to be trading indicators, at that point, you might as well just remove it from your chart and just look at it. Oh, it's going buy bullish. I'm going to start buying once I get a little bit of a sell side move, because that would show you on the indicator that there's an overwhelming turnaround right here. However, you're still bullish. So it dips down below that threshold. Like I said, there's going to be a threshold after that sell side move. It goes on for longer than it should. Then it's going to go below that threshold, and then you can buy from there, right? There's no real point at looking at it. It's not going to show you. It's delayed, right? And that's why I don't recommend trading with indicators. Supply demand zones. So most of the time, supply and demand zones are drawn out on a higher time frame, right? And there's some consolidated zone like this, maybe equal highs like this. And the idea is that once price action actually runs into this zone and shows you some sort of candle confirmation where it closes right here, like maybe 2 candles close, maybe it taps back in after pulling back and closes again below it, then the idea is that now you're going to start selling off. And the reason why this is flawed is because of a concept called liquidity, which means that there are buy stops resting above. Buy stops meaning that once it runs up above, momentum traders are getting into their positions to draw price higher. And then stop losses are there as well for sellers that were right here, right? They're going to place their stop losses above the highs. So the reason why this demand zone is flawed is that when price is around these like highs, the objective isn't to look at how the candles are closing. The objective is for price to actually build up enough orders or trade around some fair value gap so that it can rip through and stop out everybody that's trying to place their orders right here, and then price will actually return down, right? So instead of trading supply and demand, it's better to just look at liquidity and trade from the moment that price actually sweeps the highs or the lows, right? You can't actually trade this profitably where you anticipate that price just starts running down once it taps into some level. That's a flawed way of looking at price action, and most of the time you're not going to get it right. So this would be an example, like just most recent price action, right? There's these equal lows, right? Price tapped in, closed above, so it didn't actually run through. Look at what happened here. First of all, price ran on the lows, right? Closed below, maybe you start selling now. But it doesn't actually aim to like stay within the zone and go higher. It aims to sweep the stop losses and the sell stops below here. First, look what happened, right? It swept the sell stops and returned so that the sell stops got stopped out. Meanwhile, it already took out all the stop losses of the buyers right here. And then price actually continues drawing towards the bias, right? So in that case, nobody wins right there. The supply demand zones, they don't hold down, right? You expect, oh, a big candle going through it. That means it disrespected the supply zone. We're going to start selling now. And then you get stopped out. Malaysian SNR has to do with trend lines. It's like a trend line way of looking at things where it's kind of like supply demand zones, except you're on this like horizontal axis. So you're playing supply and demand, but you're looking at the trends, right? So you wait for that break of the trend, then you wait for the candle structure to actually close within, like retest this low, and then you start selling off. So the reason that this is also flawed is because of liquidity. Liquidity will disprove this like method of trading. So look, in this case, yeah, sure, it looks like a good trade, right? We had a low right here, we had a low right here. It finally broke through the low, like a little tap right there, ran down, tapped it again, and then ran lower, right? The idea of why this is flawed as well is because when, say, a break of structure happens like this, it's not actually breaking the structure of the trend, right? What it's doing instead is that it's targeting the previous low right here. So instead of looking at it as a trend, you simply look at like previous lows. Like you have this low right here, right? And these are all accumulated lows. So what happened here is it ran on these lows, and it wasn't actually the trend which it ran back into, but rather it was an order block. So ICT, right? The reason why I trade ICT is because this is the most, I'd say, perfected way of looking at price action. So we have the order block right there, right? So what happened is not a break of structure, break of trend line. It was just price sweeping the low, returning into the order block for a high probability sell. So this is how my stop loss would look, somewhere above the high, and then I would target these equal lows that I mentioned earlier as the liquidity. And you obviously aim a little bit lower because you're expecting that price creates a jagged edge out of a straight accumulated like low or high. So like once market actually starts running, we'd be aiming for these highs over here because it's relatively equal. We'd also be aiming, and notice that my stop loss is resting just right here, right? This is why market is targeting highs and lows. It's not targeting the supply zones. It's targeting the orders, right? The buy stops and the sell stops below, buy stops above, and the stop losses somewhere above the highs. And it's just like an algorithm that runs during specific times. And that's why ICT is the most, I guess, proven strategy. Because most of these other zones and like trend lines, it revolves around the way that the candles look, right? The way that some pattern forms, the way that a zone starts to be respected. And the reason why this is flawed is because you're looking at just how the candles look and not actually at the most important aspect, which is time. Time is the most important aspect in trading. And the reason why I trade ICT is because it's all revolving around time. And there's a specific concept called macros, which kind of like nail down the algorithm towards a specific way of like movement. It moves towards sell stops and buy stops during this specific 20-minute period called macros, which exist in every hour. If you want to learn it, go into ICT's YouTube channel, because I do not want to teach this incorrectly. But time is the most important thing. There's also kill zones, which are taught by ICT, which are these sessions, right? We have Asia, New York, and London. And maybe if I'm shocking you by saying that all your strategies aren't going to work, and you just can't, you refuse to believe it because you've made money with whatever you've been trading so far, sure, Okay, keep trading the way you've been trading. Like, it doesn't really matter if you're making money. Keep making money with what you've been making money with. However, you need to incorporate time, because maybe you've gotten lucky up to this point. Maybe your schedule just aligns with a specific session and you didn't know about it. But learn about each of these sessions and incorporate it into your trading style. You will be 100 times more profitable. And if you're trading supply demand zones, instead of looking at the highs and lows, treat the highs and lows as liquidity, right? As stop losses. Just start marking it out instead of liquidity, a complicated word which you may not yet understand. Mark it out as stop losses. There are stop losses, and then you'll enjoy the fact that you're trading ICT because you're quote unquote targeting other people's stop losses, right? And then for supply and demand zones, instead of looking at these respected zones, start looking at fair value gaps, because fair value gaps can be treated like that, right? Fair value gaps are an actual area where price grabs liquidity, returns, or closes above a level of liquidity and then continues higher, trapping these sellers in a, like, it's like a, not sure what the word is, like a balanced price range where the sellers, which were right here, right? It's called a sell side inefficiency. That's what a bearish fair value gap is. And when it becomes an inversion fair value gap, these sellers are now trapped right here. They're trapped because their orders are down here and market just created an inversion fair value gap. And now it's going to use the liquidity inside of here to go higher and actually take out those orders. And that's why it's called that, like, trap, because it traps them in here and it will continue on to stop them out. That's why I believe that ICT is one of the best, like, ways to look at the market. Not one of the best. It is, like, realistically the only way to look at the market, because it's all concepts that actually exist within the market. It's called price action, right? And the idea is also time frames. If you include the time frames into your, like, model, you'll understand that there's this daily bias. And that's why I always have this daily candle on my chart, because I like to think about it in terms of, like, where the daily candle is going to expand to. And then I nail it down to a specific session within the day that I will trade. Either it's the starting point before the expansion, or it's the continuation when the daily candle is somewhere right here, right? And it starts pulling back during London session, 2 a.m. right here, London session, right? We get that Judas swing pullback, and then we target it with the silver bullet, right? That's the way that I like to trade. That is the most perfect way of trading, in my opinion. Like I said, if you trade any of these, I highly recommend that you reconsider and you start diving into what actually exists on the market. If you're trading indicators, remember that it's delayed and you can see price action before. It'll be a lot less stressful when you trade before it happens instead of getting in somewhere down here, right? You get in somewhere down here and it actually starts moving because the indicator showed you that there was going to be some sell side, but you have no real idea of where it's targeting. You don't know about fair value gaps. You don't know about inefficiencies. And so you're targeting this zone, and while you could have taken profit, overall the bias is bullish and it takes you out, right? It runs up and stops you out. Then you're like, okay, my strategy works, I just didn't take profit. And then you continue tricking yourself. You're getting in at a late time. You want to learn this stuff before it happens. You want to see it happen during these specific sessions, right? See, on the 30-minute time frame, I have this indicator that shows me sessions. And you trade during these specific sessions. This is when those specific session characteristics kick in. Asia session IFEG kicks in, right? When we get this inversion fair value gap, price typically would come back and tap into it. In this case, we just got that 30-minute fair value gap right here. Price tapped it as soon as Asia session started right here. You see this little bearish candle, it tapped into it, and then we got that big bullish move during Asia session. We closed above the inversion fair value gap on the 4-hour, and then we tapped barely into it during London session, right? We had the Judas swing, and then we ran up for New York and closed. It's the most perfect way to look at price action, considering time and, like, the inefficiencies that actually exist in the market, the gaps, right? Gaps are a natural thing in the market. So why wouldn't you trade what actually exists instead of putting random lines on your chart that didn't previously exist until you drew them? That's not the way the market works. Just have to break it to you. That's it for this video. It's going to be contradictory, but that's kind of what I want. I want to gain an audience that kind of disagrees with me so that I can continue showing them my perspective of the market, how it moves, and maybe I can show them and actually teach them the real way to trade. Thank you for watching this video. Hope I could catch you in the next.